Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Jeremy Schein, and he's a partner at Corsair Capital. And what I really enjoyed about my conversation with Jeremy is we dove deep into how they invest in companies, how they really differentiate themselves along the long tail of buyout funds that are competing for limited assets, how they create enterprise value with management teams, and how they bring in resources to really focus on all the key value creation areas that are part of their investment thesis. And what I really enjoyed about the conversation is that normally we have guests on and we dive deep into specific areas that make a private equity firm's approach unique. But with Jeremy in particular, we dove deep into all the different areas and tried to get into the nitty gritty of how you actually drive enterprise value, or how you prioritize projects, or how you look at AI and how that's making an impact in their portfolio companies. And I think as you're kind of looking at your firm and your investments, a lot of those different topics likely will resonate and also be quite timely for you as well. So with that said, I'll leave you to it. Enjoy the episode. All right, Jeremy, welcome to the show. How's it going?
Great. Good to see you and nice to be here with you.
Yeah, excited to have you on. So why don't we start with your background and Corsair Capital, and let's go from there.
Yeah, sure. So Corsair is a private equity fund. We've been around since 1992. Started out within JP Morgan, carved ourselves out and spun out in 2006. Started really focused on more traditional financial services back in the JP Morgan days. Really expanded though to the world around financial services. Those are primarily non-balance sheet businesses that touch the financial aspects of businesses and consumers' lives on a daily basis. So that could be a payments company, that could be a software company, it could be an insurance services business. Really runs the gamut there.
And in terms of like the types of investments you're making, what types or sizes of deals are you looking at?
So it varies. You know, we've always had a structure where we believed it was important to have flexibility in terms of the sizes of companies that we could look at. we're primarily focused on buyout. So we believe that having control in partnership with the management teams is really important to driving returns within private equity. But, our equity check sizes can be anywhere from 50 to 250, 300. We'll bring in co-investors sometimes. That's been a tried and true method for us. We think there's value in that. Gives you perspective from other investors. Also requires a different level of thoroughness when you're presenting to more parties, and hopefully partner with people that can also add value, and 1 + 1's worth more than 2.
And so talk about that a little bit more. So, okay, I get it that you're focused on buyouts, you have more control. How does that shape either your investment strategy or on the value creation side in terms of the types of companies you're looking at, and then what you do close?
Yeah. So it's evolved a lot. Just so you know. So when we started out and we were part of JP Morgan, we spend most of our time looking at regulated financial institutions. And when you're investing in regulated financial institutions, you can't really control in the way that you can in other sectors. So there are limitations on ownership, especially while we were part of a bank. There are limitations on board rights, other control rights. So we got very deeply ingrained that if you're simply relying on a document to control the narrative, to push management to do what you want to do, we didn't think that was very effective. So we've always been very focused on collaboration and hope and believe that we want to support the management teams that we're investing in. I think, again, I've been doing this personally since 2001. So I've been at Corsair for over 24 years. And the private equity industry has changed a lot. And, we believe now that, this isn't the era of free money, obviously. You really do need to be pulling value creation levers, and you need to have a very clear plan going in to generate returns, to drive returns, and to deliver the best results for the investments that we make. And I will say, there have been periods in time where that was not the case. You've seen companies in periods where they just get flipped very quickly. That's not the case anymore. And especially now in this world that we're living in with AI and technology and software driving everything, being clearer about what you are, what you aren't, and where you can drive that value is even more important.
Right. Yeah, totally. And some of the most successful firms that we've seen have a very sharp focus. They're figuring out like, hey, we're very much on fintech as an example, or certain verticals, or health tech, or whatever, what have you, or specific stages of businesses where they really have a differentiated position or expertise that they can bring to the table. For you guys, what is that differentiator? Like, how are you different from all the other buyout funds that are out there? And there's hundreds of these types of firms that are competing for, I would say, limited deal volume, especially in the last 12 to 18 months.
Don't remind me how much competition there is. Yeah, I think it's interesting because, I think there are certain deals that, simply get won based on price. And I don't fault people for that, right? If you're a private equity firm and you're selling your business, you want to get the highest return. I think the question is, and most deals, by the way, the person who pays the most usually wins. You have to understand that. Even I like to say, even proprietary deals, there isn't really that much of a proprietary deal anymore, right? Because every company is known, right? Anyone of any size or scale is in a banker book. It doesn't matter if, your cousin went to high school with them, or, your brother married the CEO's wife, or anything in between. There's always going to be some competition. There's always going to be some market check. So the most important thing is knowing where you can drive value and where you can add value. So, first of all, our focus is relatively narrow, right? It's financial services adjacent businesses. So that is fintech, that is payments, it's insurance services, wealth and asset management, and then, business services and tech services around the broader financial services ecosystem. But then, we've migrated our operating partner model very significantly. It used to be that we were focused on bringing in industry experts. We still see value in that and having those people in our network and want them to help us and want to figure out ways to compensate. But where we've really seen more important differentiation is having operating partners with technical expertise. So in the US buyouts business, which I run, we have an operating partner who's focused on human capital. He was actually our first functional operating partner. He helps us with organizational construction. He helps us with developing the team. He helps us with assessing teams, team strengths, weaknesses, and then, going through and doing hiring. Then we have a guy who runs our operating partner team who focuses on product, technology, and human capital excellence. So he'll work with us on developing that layer into being the excellent leaders that they need to be. He has a very broad background in retail, financial services, and fintech. Then we have somebody who's focused on software, both diligence and helping us build out the right software team, the right software solutions. And then we have somebody who helps us on go-to-market. That's our most recent addition to the team, but of critical importance because we see more and more companies running into a brick wall of, not knowing how the world's changing, the market's changing, moving quickly enough, having the right expertise, pulling the right advisors in to really sharpen up your go-to-market strategies.
Yeah, I think that's a really interesting point because I think historically in private equity, even if you think about how boards are set up or how advisors are brought in, it's based on industry experience because you figure, okay, this person has relationships in this space or has some industry know-how or expertise that you can bring to your portfolio companies. And I've seen it with a lot of PE firms where it is switching, where a lot of these domains require deep technical expertise and you need the person to actually come in and get their hands dirty and understand how to kind of fix a business or get it professionalized or up level to the next level. And for that, you need true experts. So are you building all of that expertise internally, or are you kind of using this hub and spoke model where you're working with external vendors and partners?
Yeah. So the answer is, I guess somewhere in the middle, and maybe that's what you mean by hub and spoke. I mean, we're a middle market firm. We're not, one of the mega funds that can have 100 people on staff. The good news is the people that we want to go to battle with are people that really like working hard and staying busy. They will typically come and make recommendations for us. So, that may be bringing in a product coach. We have a product coach working on a bunch of companies as we work towards implementing product operating model expertise across our portfolio. It may be bringing in somebody who they know with digital marketing expertise, branding expertise. We've sort of decided that bringing in all of that expertise in-house ends up becoming a little bit too specialized. It's much more important for us to know who has the expertise across all industries and being able to implement that more effectively. Staying nimble is really important to us, though. I mean, we don't want to carry massive burdens of teams. It's also, by the way, this is something that's really important. It's really important that we have the right management team that's willing to work with these functional experts, because there are operators who say, that's fantastic. I may know a little bit, I may know how to use ChatGPT, but I don't know the latest in AI. I don't know how to be thinking about using Cursor on my technology teams. Like, you take that from me and I will work with you and listen to you, and we'll have this collaborative conversation. There are other management teams that don't want that and, don't want somebody in their hair doing that. And we want to partner with management teams that are collaborative.
Yeah, I want to touch on that a little bit because I find that there's like this tension, right? Because the management teams they're acquired in the first place because they built a great business.
Yeah.
And then at the same time, post-close, like you as a firm, there's certain things that are core to your investment thesis that you need to see play out that the management team may not have as core to their competency or skill set. So talk about just managing that dynamic and how you're able to bring in help either with your internal team or external vendors that you're partnering with to get the management team on board and also to prioritize some of the items that you've identified in your investment thesis.
Great question. Many layers to that. I would say the first thing, and I'll be honest, I think I think the world's changed a lot, even having as many sort of interactions with management teams over Zoom versus, having maybe less interactions, but in person has really changed this. But having difficult and straightforward conversations is a really big part of that. And setting the expectations correctly, right? So, when we buy a portfolio company, just as an example, we expect that we're going to do team assessments. And they're not scary, but they're very easy. They give you really great data, but some people have had bad experiences in the past. They worked at, maybe a large organization where, they were called out for having a bad 360 from somebody they didn't know. But, there has to be some trust that A, we're going to use the data effectively. And B, it's just part of our process. So that's just an example of something that, you need to lay out what's expected. And it's sort of a similar thing that I have at home with my kids. Like there's certain things that you can have conversations and debate. And there are certain things that, are non-negotiables, right? You have to eat your dinner if you're going to have dessert. Having the really clear, direct conversations is important. The other piece, which I think is important, is that, you come into these organizations, they have existed before, especially when you're talking about the middle market. Many of them get built, I would say, in sort of a just in time or, suitable for purpose sort of fashion, right? So they may have a system, a technology in place that works and has worked historically, but that executive only knows how to have gotten the business to X. We're saying if you want to actually get it to X times 3, you're going to have to make these specific changes. We work very hard on framing that out, pre-signing, especially pre-closing, and then trying to get that in front of the management teams as quickly as possible, because it can be uncomfortable at times. I've always said, like, getting uncomfortable is actually a pretty good thing, right? The danger in life in general is just being too comfortable. So that's one thing that we see happening.
How much of this, you mentioned you're doing it even before the investment. So talk a little bit about that. Like, how much are you talking to management teams about priorities, about the things that they might need to get uncomfortable about, and figuring out where those value add areas are?
The answer is that I wish it was just like a black or white answer, right? The processes get run different, the competitive dynamics are different. You want to have as much of the conversation as you can. I think probably the thing that I wish, if I looked back at my career, I wish I would have had these more and more of these conversations up front, and it's something that we're now focused on today. You have to, everybody has to be willing to have hard conversations to get to better solutions. And if you have the right ownership structures, management teams in place, there's a lot of alignment to get to the right place.
Yeah. I think getting aligned ahead of time can also be a good filtering mechanism early on about how the working relationship will kind of look as you start to work together post-investment, right? So talk about that. Like, how much are you vetting the management team and figuring out the gaps there, or if you need to up level some of the roles in order to be able to execute on some of these things beyond just bringing in advisors or operating partners to kind of help the existing team?
That happens. I mean, we do assessments of the entire executive management team right at the front. We have, as I said, one of our operating partners who manages that for us. We use sort of tried and true assessment tools, but we've also figured out ways now in the last 12 to 18 months to overlay some AI components to that, which are a bit more proprietary in terms of how we think about things. I think one of the things that's always been the most challenging in assessments has been translating the very technical aspect of a lot of those assessments into language that individuals, including investment team members and executive team members, can understand and relate to. As we've done that, and again, we've used AI to do that. We've put some of those assessments in front of the CEOs, and they've said, "Oh yeah, that is exactly my issue with Jim," and "Oh, these are the ways that you can actually go and make that better." That ends up being incredibly useful and valuable. So we do that right up front. If there are people that are identified as, not going to make it immediately, we need to have those conversations with the CEO up front. There are certain people who, or certain roles that we'll see need to evolve and develop. We can put in place a developmental plan that sort of matches our investment time horizon. The one thing though that I think is really important, and I think my guess is a lot of your clients recognize this as well, is that private equity, while we have some time, it gets late pretty early, right? So if you have changes that you need to make and your investment horizon is 3 to 6 years, and you're waiting for a whole bunch of things to maybe happen in year 2, you're going to be at that point and you're going to say, well, I can't really make that change now because, then it's too close to the exit. So it's really important to move quickly and effectively. And, I think that's why working with guys like you to get as much expertise into the organizations and private equity, into the portfolio companies as quickly as possible, as much manpower and woman power as you can get immediately, really ends up being critically important, because once the business starts slow, it's pretty hard to catch up.
Yeah, I love that. It gets late pretty early. I think that's a great saying. And I think in the first 100 days, that's why PE firms focus so much on getting things right there. But I guess the risk there is that there's so many opportunities identified at those stages, right? So how do you make sure that you're focused on those highest leverage items so that the team isn't distracted or focused on all these other things that may not move the needle? And also certain things do take time, right? If you want to, for example, launch a new part of your product or invest in an entirely new channel, like you need to give it runway and room to breathe for it to actually work. So how do you make those types of trade-offs?
Yeah, no, look, that's a great question. And that's where I think alignment with the CEO and understanding what the value drivers at exit are going to be is so critically important. I mean, I'll tell you, we have something now at a portfolio company where we have an incredibly exciting new product opportunity. And, it's several years into the investment, and we're trying to figure out, how do you do that? And the management team's asking the same thing. So we're trying to come up with creative solutions to still go after those opportunities, because, you want the organization to build as much value in the future as possible. But that does get difficult. I mean, I'll give you, maybe the best example that I can think of is, we carved out a business called TreviPay, which is a B2B payments business that we carved out in the middle of COVID. And, we had exclusivity from, I think a few weeks before COVID through, the end of lockdowns in August, because, everybody was so confused. Nobody knew what to get. But, the company at the time had been underinvested in by the parent company for reasons that made sense for them. And we knew right away that, if we were going to take this company to the level of and to be the business that we wanted it to be, we were going to have to make some significant hires immediately. So, brought in a CFO even before we had closed the deal in that case. And we needed to get go-to-market right. And by the way, we did not get go-to-market right in that first year. It took us probably the business, because of the tailwinds and because of how good of a business it was, kept growing. But because we made those immediate changes in go-to-market, we were able to have enough time to experiment so that by year 3, we had the go-to-market motion in place that was critical for the long-term success of the business. That also included, in that case, we rebranded the business. We had to do some sort of core things because it was a carve-out to set up the core infrastructure and technology of the business. But, you don't have to always get things exactly right at the beginning. It's more important that you actually make decisions because, you can always unmake a decision or change course. But, if you wait too long, it becomes a lot harder to do that.
How do you determine, you mentioned rebranding and some other infrastructure projects, like how do you make the trade-offs between, let's say, taking on a project like that where it's not necessarily going to make an impact on enterprise value creation or revenue growth in the short term, but you're kind of making this bet on the long term. And it is a bit of a distraction too, because there's business as usual work that still needs to kind of happen. And there's other items in the value creation plan that you might have. So when you decide to take things like that on or think it's kind of worthy of an investment?
That's a great question. I hadn't really thought about it like that because usually when it's really important, you need to do it. This case, they had no brand awareness at all. So it was the right time to do it. I think one of the most important questions, is there a brand to begin with? The other thing, and again, on your side, you probably see this, is you can't really be like half in on a lot of this stuff, right? So if you're going to support a brand, you've really got to go in. Otherwise, you're not going to get any data back that says that the brand's has any value or that it's being effectively managed or marketed or anything else. But, I think brands really important today. People, and it's funny because TreviPay is a B2B payments company. And one of the parts of our thesis at the beginning was that B2B payments lagged the consumer payments market. I think that's clear. And one thing we were seeing, and this was back in 2020, was that there were user experiences that we've all gotten used to on the consumer side, right? That was Apple Pay, that was Venmo, that was PayPal. And then you get to the commercial side, and invoices are complex. Payment on terms is very manual, still lots of checks, ACH, wires. And it was part of our thesis at the time was that what we have all, businesses and commercial entities are made up of consumers, and they were going to start demanding some of that efficiencies that they'd seen in their consumer life, in their commercial side. And my point in saying all of that is that's sort of the same thing with brands as well, right? So businesses are made up of people, and they care about the brands. They care about what it means for, they want to be proud of the companies that they partner with, and logos matter, colors matter, your website matters, how it actually adjusts to a mobile phone matters, even if nobody really goes on that site. So it says something about the business, and it's important.
Yeah. No, totally agree with that. That's great. How much of this work that you're doing is being informed by your path to an exit for a particular investment? Where you're buying this company, okay, your whole period, let's say, is 5 to 7 years but you're kind of forecasting out, okay, in order for us to be able to exit it in 7 years, here's what needs to be true at the year 5 mark or year 3 mark. And how are you using that to kind of inform your prioritization?
I mean, that's critically important, right? And, one of the challenges with having now experts on product technology and human capital marketing is that they're all coming and saying, you need to spend more money here now today. And they're mostly right? You got to make sure you're not making penny wise, pound foolish decisions. I think it's because we're private equity, and I think it's something that maybe all of us are not necessarily as good at, is, it's important to go and look at the warts in the business as well, right? And to know where some of the challenges are, and when somebody's coming to potentially invest or buy or take a stake in your business in the future, where are they going to get hung up, and where can they see lower value? So start knocking those out and making sure, by the way, today, I think making sure you have a tech stack and product roadmap that's up to date is probably the most important, because everyone's first question is, how's AI going to impact this business? And it's a really complicated answer. It's pretty hard to figure out exactly where AI is going to be the tool and where it could displace some areas of your business. So you've got to make sure you have modern thinking product tech and CEOs as well.
Yeah, talk about the AI stuff, because that is obviously the topic of the year, I guess, around PE, and every company's kind of thinking about it. So how are you factoring that in? Because in a lot of cases, there's this existential threat of AI potentially displacing what a particular platform might do, or completely changing the business. And you kind of have to make these decisions on what to prioritize to stay relevant or not get displaced. So how do you think about that as you're making these investments?
Yeah. So I guess there's sort of two answers there, right? One, we have a portfolio of assets, right? So, and many of those investments we made before AI felt as current as it does today. So on those, first and foremost is, we're working with our operating partners, we're working with third parties as well, to make sure we are using all of the tools available in AI to be most effective. So that's, products like Cursor. That's, if you're thinking about doing rebranding and marketing, there are AI tools that can help you go much faster and be more effective on that. It's, by the way, it's when we're looking at brand relevance, making sure that your marketing teams aren't only thinking about traditional Google search, but understanding that it's a very high percentage of the population that is going to go to AI to get their answers now. And those have slightly different algorithms that could lead to different results. So that's the first thing, is like, you've got to embrace AI tools within your business to make it better. We ask the question now when we're looking at all of our portfolio companies that we own today, as well as and especially new portfolio companies that we're thinking about investing in today. Like, we are asking that question, like, how does AI displace this? And, it ends up being a pretty long part of our investment committee discussions. People, throwing things against the wall. I think you have to have a reason to exist. Again, because we have operating partners that are really deeply versed in it, I think we can get into a more technical bit of the conversation of, like, where is AI today? How can it do this today? But then, the more important thing is, like, what can it do in 5 years, right? Once you start talking about agentics and other things, what's the level of accuracy? Like, how does hallucinations, how would that impact the business if it was a simply AI built business? But it's a core piece of the conversation right now. We're not investing directly in just pure AI businesses. That's not what we do. So we need to have good answers as to why these businesses should and do exist in the future.
Is in any way, do you feel like the AI hype and how much people are focusing on it does it feel overblown in any way as well? Because there's both sides to it. On the one side, yes, it's an existential threat and there's a lot to factor in. And then at the same time, like core businesses are still running and still working and still servicing a need. And there was a study recently that talked about a lot of AI pilots are actually not working. I think it was done by MIT. I think it's 95% is the number they quoted. So I'm curious, like in the work that you're doing, are you seeing that where, yes, there is a risk, but there's time to integrate this, and the core businesses that you've invested in have so much value that it's very hard to displace in many ways, and the existential threat might be overblown?
I think it depends, right? I think there are businesses where people are paying for something, some type of data, some type of product that, you see AI coming in. I mean, I think the real area where AI is really useful though is in the ability to, product test, right? And to experiment quickly, right? And fail fast, right? Like failing fast is really important. But by the way, that also means even if you don't think that you're going to get displaced by a bot, you've got to think about what your competitors can be doing with AI as well. So, can they use AI more effectively than you can to drive down costs, to lower their price, to reach their target markets more effectively? So, even if we're not living in a world where just every company is owned by AI, it's part of the world now. So you've got to be able to be thinking quickly and nimbly and build your businesses effectively.
Oh, that's great. I know we're coming up on time, but if there's people listening that want to get in touch with you or learn more about Corsair, what's the best way to get a hold of you?
Yeah, you can send me a message on LinkedIn. It's probably the easiest, and I will circle back. It's Jeremy Schein, Schein, and there might be another one now on LinkedIn. I'm not sure. I haven't checked in a while, but send me a message and we can connect.
Awesome. All right. Well, Jeremy, I appreciate you coming on and sharing your wisdom. I think just the way you've talked about how you guys look at investments and how you help create value for your portfolio companies, I think it's great that we got into some of the details there because we don't get to do that on every episode. So appreciate you coming on and sharing your wisdom.
Thanks so much.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.